Hi. So if you're watching this video, you're probably preparing to get a commercial real estate loan, perhaps as an owner occupant, starting a small business, and either getting close or maybe it's down the road. And so my name is Dave Cotter with Integrity Capital out of Scottsdale. And I just want to spend a few minutes preparing you, educating you as to what it is you need to do in order to have the highest probability of getting a commercial real estate loan. So let me walk you through a few things to focus on. The first one is cash flow. So you really have to have good books. I can't begin to tell you how many times people come in here and they try to show as little profit as possible. They show losses, and it's really, really hard to get a loan unless you're actually making money, or at least showing you're making money. And so you really need to make sure that you're making money and profitable, specifically for your tax returns, your corporate tax returns, is where they're going to really spend some time. So they're really finicky showing profit. And here's the magic formula. It's really debt service coverage ratio of 1.25. That's the magic formula. And you're probably saying, what is that? So if you purchase a property for $500,000, and let's just say you have a loan for $450,000. So that's 90% loan to value. With a 25-year amortization at 4.5% rate, your payment would be about $30,347 a year. Okay, so that's principal and interest. So the bank wants to see 1.25. So if you just took 1.25 and multiplied by that, you have about a $37,934 profit. So that's what they're looking for, is that your profit has to exceed the payment by 1.25 or 25% above break even. And you say, well, what's that? Well, it's your revenues minus all your operating expenses and your net income. And they're going to take your net income on your tax return and they're going to add back your interest expense. They're going to add back any depreciation. And if you're renting, they'll add back rent if you're going to leave and go and buy a building. So just remember that they'll add those back, and rent specifically if it is you're not going to have rent anymore. That's how they get to that net number, and then they divide that by the denominator, which is your payment, and that'll give you the ratio. So if it's 1.25 or higher, then you're looking pretty good. And you want to have that for at least 1 year of the most previous year. And by the way, they don't give a lot of credence to just P&Ls for the interim. They want the actual tax return. The second one is credit. So just make sure you have clean credit. You don't have a good FICO score. Well, that's more than that. They want to see that you have no bankruptcy, foreclosure, short sales, lawsuits in the last 7 years or so. It's not a deal killer, but you would have to have a pretty good explanation of what happened. The third thing is credibility. So think about this. Do you know the industry? Have you had experience there, or light kind experience that they can get their arms around? That's usually a good thing. Of that third C is credibility. Do you have experience? Have you been a CPA starting your own? Have you been an engineer? Have you been a doctor? Have you been in a light kind industry that would be helpful? So credibility really matters. The fourth is cash down payment. So where's the cash coming from? If you're doing 10% down, you ought to be prepared for 12, closing costs, and et cetera, et cetera. And so you want to have that at least seasoned for probably 30 days. That can come as a gift from a friend or family member. It can't be debt, but it could be a gift. But they just want to see that you have some cash and that you're not completely drained once you actually buy the building, that you have some cash reserves of a couple of months, 3, 4, 5 months after. And then the final one is just collateral. So do you have sufficient collateral? When you're doing an SBA loan, they're going to, if you're buying it for $500,000, they'll discount it by 15%, and you have this deficiency, call it of $75,000 or so. If you put 10% down, you have a 5% gap. So they're going to take that $25,000 or so and say, do you have a mortgage and a piece of real estate that they're going to put a second on? A lot of times they're going to want to shore up additional collateral just in case there's future defaults and things of that magnitude. So this is just a little quick snapshot for you as small business owners trying to go get a loan. It's not easy, but hopefully this will be beneficial to you as you prepare to go get a commercial loan within the industry of financing. So my name is Dave Cotter. If you have questions, 480-219-1205, or you can email at dave.kotter@integrity-capital.com.